Welcome to The Explainer. Today, we're putting a true healthcare titan, Pfizer, through the ultimate valuation gauntlet. As an investment analyst, I absolutely love looking at a stock that completely splits the room, and Pfizer is exactly that right now. On one hand, you've got these incredibly resilient cash flows, but on the other hand, the company is staring down the barrel of a massive patent cliff in 2026. So we're going to strip away all the noise. We'll run Pfizer's first quarter financials through the strict, battle-tested frameworks of legendary investors Warren Buffett, Peter Lynch, and Benjamin Graham, before finally stress testing it all with a discounted cash flow model. Here is our roadmap for today. We'll start off with a quick company snapshot, then we'll view Pfizer through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll dive right into DCF and alternative models, and wrap it all up with our final verdict. Okay, let's dive right into Section 1, the company snapshot, where Pfizer stands today. Pulled straight from their Q1 financials, Pfizer is currently trading at just $24.04 a share. But what's immediately catching the eye of income investors everywhere is that massive 6.36% dividend yield. To put that into perspective, Pfizer paid out a staggering $2.45 billion in dividends just in the first quarter alone. But there's a catch. Here is the core tension driving that low share price. Pfizer is facing a monumental 2026 patent cliff. That means exclusive rights to several of their blockbuster drugs are expiring, which opens the floodgates to cheaper generic competition. Yet, despite this looming threat, management is still projecting a really robust $59.5 billion to $62.5 billion in revenue for 2026. So the big question we have to answer today is, does that high yield make it a hidden gem, or is that patent cliff turning the stock into a classic value trap? Moving right along to Section 2, the Warren Buffett lens, moats, management, and margins of safety. We all know Buffett loves a monopoly-like advantage, right? A moat. Historically, Pfizer's patents acted as a super wide moat, but that 2026 cliff is kind of draining the water right out of it. However, when we actually look at the fundamentals, Pfizer passes some major Buffett quality checks. Return on equity is sitting at a very solid 15.85%, which shows efficient profitability. And with a debt-to-equity ratio of 0.71, which comes from roughly $60.6 billion in long-term debt against $90.1 billion in equity, the leverage is highly manageable. Now, to figure out what Buffett would actually pay, we have to calculate approximate owner earnings. By taking Q1 net income, adding back depreciation and amortization, and then subtracting capital expenditures, and annualizing that whole thing, we get a very healthy $15.48 billion in cash that an owner could theoretically just pocket. So the business is clearly generating massive cash. But a core tenet of Buffett's philosophy is never, ever overpaying. We have to ask, is there a true margin of safety for the Oracle of Omaha at current prices? Based on that massive owner earnings yield, a conservative estimate places Pfizer's intrinsic value around $30 per share. But Buffett typically demands at least a 20% margin of safety to protect against unforeseen errors or, in this particular case, a worse-than-expected patent cliff. Taking 20% off our $30 intrinsic value puts his hypothetical trigger price right at $24. At today's price of $24.04, it's sitting squarely on the fence for a Buffett-style value play. All right, let's shift gears to Section 3, the Peter Lynch lens, categorizing the growth story. How would the legendary mutual fund manager categorize Pfizer? Well, in Lynch's universe, Pfizer is undeniably a stalwart or slow grower. With a massive market cap of roughly $153 billion and a pretty asset-heavy balance sheet, it literally physically cannot grow at the 20+% rates Lynch sought out for his fast growers. Companies in this specific category are expected to provide single-digit earnings growth and, of course, pay a fat, reliable dividend. Now, what's really interesting about this slide is the PE ratio. That's price to earnings divided by the growth rate. Lynch looks for a score below 1.0. Pfizer currently trades at a PE of 20.53. Because of that impending patent cliff, we have to assume a highly conservative growth rate going forward. Let's call it 2%. Doing the math, that gives us a PE ratio of a staggering 10.26. While the balance sheet definitely has high liquidity to service its $60.6 billion in long-term debt, that PE ratio is just a glaring red flag for Lynch's methodology. Because of this, our hypothetical Lynch verdict is a hold or a sell. Lynch loved a good dividend, sure, but he absolutely hated overpaying for slow growth. Without a hidden asset play or a clear turnaround catalyst beyond the patent cliff, the valuation is simply too tough to justify for his specific strategy.
Section 4. The Benjamin Graham Lens, the strict quantitative stress test.
Benjamin Graham required stocks to pass a pretty brutal gauntlet of defensive criteria. Now, Pfizer easily passes for adequate size, and it has a strong current ratio of 1.25. Its legendary dividend record is obviously a solid pass too. However, it completely fails Graham's requirements for earning stability and growth, mostly due to the wild volatility of its pandemic-era revenues and some recent negative EPS growth. Furthermore, Graham wanted a PE under 15. Pfizer is way up at 2053. He wanted a price-to-book under 1.5. Pfizer is sitting at 1.71. For a strict Graham defensive investor, there are just too many alarms ringing here to let this into the portfolio. We can actually prove this mathematically by using Graham's famous intrinsic value formula, the square root of 22.5 multiplied by EPS and book value per share. If we use an annualized EPS assumption of 188 and Q1's book value of 1585, the math spits out an intrinsic value of 2589. At today's price of 2404, there is practically zero margin of safety. Honestly, Graham would demand a price closer to $17 before even giving this a second look.
Let's move to Section 5. DCF, and alternative models, Wall Street's mathematical gauntlet.
A DCF, or discounted cash flow model, values a company based on the present value of its future cash flows. To build this out properly, we have to make some very clear assumptions to fill in the gaps. Step 1, we project out free cash flows, modeling a standard decline over the next few years just to account for that patent cliff. Step 2, we calculate the terminal value, assuming a perpetual growth rate of just 2%, which basically mirrors long-term inflation. Step 3, we discount it all back to today using a weighted average cost of capital, or WACC, of 7.5%, which is pretty standard for a mature pharmaceutical firm.
And this brilliantly illustrates just how sensitive Pfizer's fair value is to those assumptions. In our base case, that 7.5% discount rate and 2% growth, the fair value sits at $22.50, slightly below the current trading price. If we decide to be a little more optimistic, lowering the discount rate to 7%, the fair value jumps to $26.10. But if that patent cliff hits harder than expected and growth drops to 1.5% with a higher cost of capital, well, fair value plummets down to $18.80.
If we cross-reference this against a few alternative models, the picture becomes really clear. Comparing Pfizer to industry peers on a PE multiple suggests a fair value of around $18. Using an EV to EBITDA multiple suggests $20. The only model that justifies a premium here is the dividend discount model, or DDM, coming in at nearly $30. Why? Well, because the DDM values a stock strictly based on the present value of its future dividend payouts, and as we know, Pfizer's payout is absolutely colossal.
Finally, Section 6, synthesis and final verdict, bringing the gauntlet all together.
Here is our master scorecard. For an income-focused value investor like Buffett, the stock is right on the cusp of being fairly valued at $24, supported entirely by its incredible cash flow generation. The dividend discount model totally agrees. However, if you have strict growth criteria like Peter Lynch, or demand a deep quantitative margin of safety like Benjamin Graham, Pfizer is simply too risky to touch right now. Our base DCF model basically splits the difference, targeting $22.50, suggesting the stock is fully priced for the risks it carries. So what does this all mean? Our final verdict today is a hold. If you already own Pfizer, that 6.36% dividend yield essentially pays you to sit on your hands and wait for management to navigate the 2026 patent cliff. However, that sky-high PEG ratio, the lack of a deep margin of safety, and the impending generic competition severely restrict the potential for any meaningful capital appreciation in the near term. It is a fantastic income generator, for sure, but a fairly poor growth vehicle. Which leaves us with the ultimate question. Does Pfizer's survival through this valuation gauntlet actually align with your personal portfolio philosophy? Are you willing to brave a looming patent cliff for a massive dividend check, or do you demand growth and a deeper margin of safety? Let the data guide your decision. Thanks so much for joining me on this explainer, and keep learning.